You're listening to the Goldnomics Podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed. Hello and welcome to episode 9 of the Goldnomics Podcast, where we're looking at global financial markets through the lens of precious metals. And this week our guest is Francesco Filia, who is a regular outspoken contributor on CNBC and co-founder and CEO of Fasanara Capital. And Francesco is talking to Stephen Flood, CEO of GoldCore, your precious metals expert, and they're talking about the current state of financial markets and why you can no longer trust the performance of stock markets as a barometer for economic performance. But before we join them, I'd like to just remind you to stay up to date with each and every episode of the Goldnomics Podcast by subscribing on YouTube and hitting that notification bell to be notified each time that we release an episode of the podcast or indeed any of our videos. And you can also catch us on iTunes and SoundCloud. But for now, let's join Stephen and Francesco.
Hi everybody, this is Stephen from GoldCore, and today we are interviewing Francesco Filia. Francesco heads up all portfolio management and research and related activities at Fasanara, I should say. Prior to co-founding Fasanara, Francesco was a managing director of EMEA, head of the principal investors group at Bank of America Merrill Lynch, and he's a regular guest on CNBC Squawk Box. So welcome, Francesco.
Hello, Stephen. Nice. Thank you for the invite.
Yeah, great stuff. Listen, it's really, really great to have you on the podcast today. I came across your work. You did an article there recently called Fake Markets. This is something we have an interest in and have done for many, many years. In that article, you had a very interesting quote. You said, in the equity markets, close to 90% of flows can be attributed to passive strategies, and in 15 years ago it was just 7%, and this is according to Vanguard and the CFA Institute. Could you just explain for our audience what exactly that means and why it should be of a concern?
No, absolutely. Like fake markets is just the buzz word that we use applied to markets these days because in recognition of the fact that markets are not responding to fundamentals, and they've not been responding to fundamentals for a while now. It's really a few years, and we can see that in a lot of different places in the market, in the form of pricing anomalies, and in the form also of behavior from market participants. We can see that the news events have less of an impact. We can see that corporate releases, earnings and stuff like that have less of an impact. It can be measured in multiple different ways. And it is a reflection of the fact that the market has been heavily manipulated by monetary authorities, like in an intentional way, as quantitative easing was taking hold over the last 10 years, together with extra low interest rates in the form of negative interest rate policies and zero interest rate policies. So the combination of interest rate policies and the quantitative easing has created fake markets because it had a strong positive feedback loop or like impact, direct impact on the private investment community, which then kind of followed the flows of central bankers and therefore created a monstrosity in a way in a market which is unable to respond to fundamentals any longer. If you look at quantitative easing, like even just the US markets, $5 trillion got printed by the Federal Reserve, and as a consequence of that, you had for example, in the private markets, you have buybacks, which by the end of 2018 will have reached the cumulative amount of another $5 trillion, so as big as quantitative easing on the side of US corporates. And in addition to that, we calculate more than 15 trillion of private flows from investment managers globally that are following central bank flows in the form of an high correlation between investment strategies, for example, passive strategies through ETF, but also index replica and passive index funds in the forms of low volatility vehicles, in the forms of also quant funds, in the forms of passive investment through factor investing and risk premium, and also risk parity. A lot of different acronyms, but they stand behind the same investment style, which is long only with a high beta and short volatility. This is what
It's amazing. So what you're saying is that basically central banks have obviously printed an awful lot of money. You have a belief in the capital markets where people invest on a passive basis. Now, passive. Could you explain for our audience what passive investing means as opposed to, I think the alternative is active investing?
Yes, in the old days, like you wanted to access the markets as a retailer, as a retail investors, and you were giving your mandate to an active manager for these active managers to be at the wheel, to be driving the car.
Yeah.
These days, nobody at the car. It's really like a self-driving Uber electric car, like in all sense. And basically, you give the money to a passive ETF or like a similar instrument that is without a manager and goes passively into replicating the markets through a heavily diversified portfolio of stocks, for example, which they represent the US market or the emerging markets or the energy market. There are different ways for you to access the market as a retail investor. And that is in itself is just the future, it's just technology. But it has also got a component of systemic risk. So like if everybody goes passive at the same time, nobody's looking at valuations anymore. So there is a tipping point beyond which this creates a systemic risk. This is nothing to say that this is not the future. The future, fortunately or unfortunately, it doesn't matter, but it will look like, the Uber of finance or the Amazon of finance in the form of ETFs and passive investment vehicles. Yeah. But at the same time, in the short term, which means the next 2 to 5 years, is creating huge issues and systemic risk issues. Like when, that is renowned the fact that you should sell the market when the retailers are coming in. Because that is typically a tipping point that is typically pointed
when the dictators.
Yes.
Wow. Okay.
The retail investors.
Retail.
Retail investors, they come in and they control the market. Is when you want out, because it's at the point in time in which they bought the peak of the market, typically over history. Now you could say that this is it these days through ETFs, which are giving an access which was prior to these times not available. Yeah. So it's an access to the market that is really making the difference. That together with also investment managers of all sorts that have been launching all sorts of flavors of investment strategies that really doing the same thing all at once, they create a systemic risk. And, the main point of systemic risk, and we look at it from the complexity theory point of view, from the systems theory point of view, is that individually you can do something that is entirely rational. But if everybody does the same at the same time, it becomes systemically important and systemically relevant and systemically problematic. And this is the point. If everybody is doing the same thing at the same time, we are all on the same side of the boat. The boat can capsize. And this is exactly what is happening right now. Yeah,
and I think ETFs have been great in terms of giving investors access to the markets for low cost. It's kind of buy and forget, but they're predicated on a market that is always kind of trying to discover value and try to discover where the value is in the market and where the best performers are in the market. So you have these people bidding it out for, or duking it out for a bid on the bid and ask. They're looking at the balance sheets, they're looking at the executives, they're looking at what's happening in the research and development, and they set the price for that stock. And then you have the retail investors carrying, following with the ETF, and it's efficient. But if it becomes too big and that flows too big, it overwhelms the market. And I think I saw something recently where stocks were more correlated with their membership of an index than they were with the news flow that they were creating as companies. So the CEO could go out there and dress in a tutu and stand on the steps or whatever, whistling Dixie, and the stock would move unless the index was moving, and that was it. I mean, and that says it all, doesn't it?
It does. This is one of the best examples. By the way, the research that you're referring to, I think it's a McKinsey research from a year ago. Yeah. And it's very interesting because they correlate. They analyze the lower correlation to the earnings of the company on a broad number of stocks. And so this is scientifically measured. Let's say by multiple parties. There is a growing body of research that looks into that, and yet nobody cares. Yet nobody really raised the flag saying, "Guys, this is going too far." And you can imagine that the policymakers, the regulators, were all over this, trying to spot points of anomaly. And also the tendency for anomaly to increase to systemic levels, but nobody is. And they use plausible deniability, if you want to call it that way, meaning that if there is a crash, nobody could see it before. A bubble cannot be known in retrospect. How many times do you hear that? There's no way you can really spot it, which is totally untrue, in my opinion. There are a lot of tools you can utilize. We've just stopped using them.
You can see imbalances in the market developing. It's blatant that you have bad actors in the market in the form of central banks. Like look at the Swiss National Bank. They are huge players in the equity markets. I think it's about 120% of GDP now. Swiss GDP is actually involved in market manipulation, and essentially they're printing money, which devalues the money of their citizens. And if this market hits an event and it has a 50% retracement down, what does that do to the finances of somewhere like Switzerland? This is systemically important. It's a big deal.
This has become systemically important. The impact of ETF and passive index strategies is really under-researched, but at the same time, we have a long list of anomalies, a long list that can point to the fact that these prices they do not make any sense anymore. There was another beautiful example from a research from Horizon Kinetics, for example, that really caught our attention, which is that, you could see at some point last year, the Russian dollar-denominated government bond trading at a yield below the US Treasury for the same maturity, which was kind of totally impossible to get, because you can imagine, this product they should trade at a spread. And the only reason why that was happening was because ETFs, emerging markets, passively managed by some of the largest houses. So these are not niche players. They were buying indiscriminately this Russian bond because it was representing 9.99% of their holdings, just not to hit concentration. So they were buying it irrespective of the value and the fundamentals. And I have a lot to say when I hear that, there is a defense for passive investors saying, in reality, they are active as well. In reality, they are driven by valuations. That is not true, looking at the empirical evidence coming from the market on a daily basis. In this case, for example, there was no reason on earth why the ETFs should have kept buying a bond issued by Russia, denominated in dollars, and trading at a yield lower than the US Treasuries for the same maturity. And yet, they were keeping on buying it.
There's so many examples of this in the markets. The one I heard there recently, just to throw it out there, was let's say in Greece, and it has an enormous amount of economic problems. Greek systemically important banks purchase Greek government debt, and they call it Tier 1 capital. And the ECB, when they examine the strength of European banks, give Greek banks a pass, saying that their Tier 1 capital is adequate for the risk that they're taking. And then they don't actually say what that debt is, but because they automatically give it a zero risk of default because it's a government debt from Greece, which is a complete sham. I mean, it's an utter nonsense. And this is what happens when you have flows of money coming into a market. It perverts the actual the function of a capital market, which is to set the price of credit and set the expectation for return and to manage that. And it's a perversion of that.
Yeah, there are a lot of perverse incentives in the market. I mean, I don't think this is there are always perverse incentives in the market. You can argue that there is always something like that around. Now, the point with today's market is that this has reached a systemic scale.
Yeah.
This is on a massive global environment, looking at the main asset classes for the main countries, like equities and bonds for Europe and the US and Japan. So this is the difference than the past. Because you could argue that there were anomalies also in the way that accounting works and regulatory works for insurance company pension funds, which are led to own assets at very tiny yields because the regulatory capital requirements is in such and such a way in which the return on equity is 20% or plus.
Yeah.
But still, it's something that you wouldn't own on your own normally. And so it's creating a very perverse incentive.
There was in that report. I thought there was a fantastic quote in there where you describe what a fake market is, and if I could just read it out for the listeners and viewers. Fake markets are defined as markets where the magnitude and duration of artificial flows from global central banks or passive investment vehicles have managed to overwhelm and narcotize the data dependency and macro factors. There's a bit of a mouthful there. A stuporous state of durable, unvolatile overvaluation and arrested activity, unconsciousness produced by the influence of artificial money flows. So it's really well stated, and I love that whole idea of narcotize and the data dependency of macro factors, which is exactly what we're seeing here. The people like us are kind of jumping up and down saying, wake up, the music is about to stop, and half the orchestra have already fallen off their seats dead, and the conductor's still playing as if the music is fine. I just want to ask you, how does this all unravel? What does it look like? It's going to get ugly, probably. What does it look like for the average investor, for people in the markets, for the market systemically? I know you mentioned a potential for a 90%, you said a 90% chance of a 40% peak to trough fall in broad indices, maybe between 2 and 5 years out from now, which is safe. I would argue it could be even greater than that. I don't know, but certain sectors might be more affected than others. But how does this affect investors, families, the markets in general? What can we do as investors?
Yeah, it's difficult to put probabilities. Obviously, it looks like punting and a bit of throwing them numbers just like that. Try to be as scientific as we can about it using complexity theory, and because one of the concepts is complexity theory is that you can actually measure to some extent within certain range of confidence, like the probability of a transition, which means the proximity that we are to a market crash. Just not to use jargon from a theorist and just speak about the market. And there are things that can be done in order, they've got to do with the analysis of early warning signals.
Early warning signals, okay.
Early warning signals, yes. Which is not the typical ones that we typically look at in finance. We look at the leading indicators, so we look at the bubble indicators, so we look at valuations, price earning multiples, the Schiller adjusted, Hussman adjusted, and stuff like that, which we always do as well. But they are more taken from physics and from ecosystems. The good point with the complexity theory is that there are certain commonalities across, independent of what you're dealing with, finance, but also the human brain, schizophrenia, epidemics, lakes, ecosystems, fisheries, and all of those, when they go through critical threshold, they tend to exhibit similar characteristics. Things like critical slowing down, flickering, covariance, pockets of stress, things like that. So we try at Fasanara to measure them in a quantitative way. We came up with these, which we call system resilience indicators, which means really indicators of systemic risk.
Yeah.
We think that there is a lot that can be done better. Nobody cares really about it, but we still do it. And we think that is much better than the VIX, for example, when you look at systemic risk. I'm not talking about the market going up or down tomorrow. I'm talking about the build-up, the compounding of systemic risk to the point where they might give serious trouble to the overall economy as well. And provoking a recession, a loss of jobs, a loss of GDP and output and stuff like that. Systemic risk indicators, they could do a much better job than volatility-based indicators. Volatility as a measurement of risk has been proven to be flawed.
And volatility is basically the rate of change of prices over a time period. So if the prices are going up and going down quickly, many people in the market say, well, if that volatility is increasing, then that means the market is in some sort of state of panic, and therefore it's risky.
Yes, which is wrong. I mean, it is right in the short term, but it does nothing to help you understand systemic risk.
Yeah.
So for systemic risk, it's the opposite. Systemic risk, they compound after prolonged period of low volatility.
Yeah.
This has been proven decades ago, or discussed decades ago by Hyman Minsky, which because he's the famous guy of the Minsky point, the points, the threshold beyond which a company cannot pay anymore for its debt. And, chickens comes home to roast, I think you say.
Roast.
And I surely misspelled it. And but basically, John Danielson at the Systemic Risk Institute is also calculating that quantitatively, thinking that how long does it need the volatility low for you to create the troubles in the real economy, in the financial markets, in the form of over leverage, over extension, over lending on the banking side, but also about the markets. So we think that our indicators, they take into account not volatility, but the structure of the market. So we look at things like entropy, the Ricci curvature, things like that, but they're always intended to measure the structure of the market and how much it may be going into a transition from the viewpoint of low volatility, not high volatility. If you think about it, it's a big thing because most of the value at risk metrics, risk metrics and stuff that are looking at the market are taking volatility as a risk indicators. Yeah. Now we are moving into expected shortfalls and expected drawdowns, but they're really still about volatility, which is really flawed, but everybody's using it, which makes it systematic and systemic in terms of risk and potential risk.
And it's just interesting on that, in terms of everybody's looking in the wrong place to understand if we are at risk. And it's interesting you say in low volatility is actually when the systemic events are actually building up. And you mentioned, I think, in one of your pieces that the rate of recovery, so when you have a sell-off in the market, how fast does it take to get back to a peak? And that rate of recovery is actually quite indicative of the temperament of the market, its belief in itself, perhaps, and but that's an interesting one, and it goes to complexity theory as well.
Absolutely. Like, it may sound like a bit obvious, right? That when you get into trouble, you start to give trouble, the market starts to give trouble, then you have the rate of recovery that decreases, right? So the speed at which you go back to all-time highs decreases, right? It may sound obvious.
It's like a rugby player. He gets tackled. How fast does he get back on his feet? He's getting late in his career. He's getting up a little bit slower.
No, exactly. It's like the Tyson getting knocked out progressively, and it takes always longer to get back on his feet. It tells you something informative, and what it tells you is that this is true not just for the financial markets. This is the important point here, and I find it also very fascinating, is that it is true also for epidemics. What is the time after which the epidemics really spread out? Or for like a desertification? What is the point beyond which there is no return, beyond which there is desertification, after which the grass disappears completely? There is a tipping point. And this is a critical slowing down, which is the speed of the rate of recovery. It can help you detect that. It's telling you, it's like the system telling you that something is wrong. And we are not paying attention, we are not listening. Like my best comparison, one of the ones that I use the most is Lehman. What happened in Lehman in 2007, 2008? Was it due to subprime mortgages? Was it due to Lehman defaulting and not being rescued? And the point is, no, it was not due to any of those. So the textbooks is telling us it was due to real estate, subprime, it was due to Lehman. But the reality is that it was not due to any of those. It was the system that was at tipping point, ready to transition. At the end of the day, it was a house market. It could have been something else. But like history tells us that was the housing crisis. That was not the housing crisis. That was a credit bubble that got into transition. It could have been anything happening, the so-called butterfly effect. So it could have been any disturbance to a system in transition, to a system which is full and heating capacity constrained, that provokes a large rupture.
This is really interesting because I read somewhere that human beings have a natural tendency to try to simplify the complex, because that's the way we learn. We like to have a simple explanation for things, we put in our back pocket, and when something happens again in the future, we can just take it out and go, I can understand the situation. And that's how we think. But in complexity theory is actually, what you have is an awful lot of elements. Their interactions are constantly changing. The weighting of those effects is changing as well. It's hard to say if any one thing is going to be enough to actually break the system. But if it's not operating properly, like an engine in a car, you can have one small event like a seal going in one part of the engine, but it has a catastrophic effect elsewhere.
Absolutely. And one of the points with the complexity theory and systems theory is that it may be very difficult to analyze and predict the individual behavior of each one of us, but it becomes more predictable, the system as a whole, the group of people. Is much more predictable than one single person. A flock of birds can be more predicted in an easy way than each one of them singularly taken. And definitely the human brain is unable to deal with that. Behavioral finance has analyzed a lot of mental quirks and mental traps, cognitive dissonance, like the Monte Carlo bias, the recency bias, all of those, and did a great deal in improving what we had before.
Our understanding,
behavioral finance, which was really only the efficient market hypothesis, which was even more flawed because it was assuming everybody was dealing rationally. Behavioral finance stepped in, but then I feel like we are short. We are still falling short. And what I think is missing personally, amongst other things, is a better way to deal with systemic risk, but also the utilization of complexity theory for analyzing markets. So look at markets more from a systemic perspective and not so much from the single component of each.
So what can an investor do at the end of the day to insulate themselves from as this transitionary phase where our existing markets are being found wanting? We have bad actors, I would call them bad actors, in the markets, and it's having a systemic effect. It might go, we might have an event whereby there's that transition does happen. What do investors do? What can they do to protect themselves?
But in our, to play a small role in that, we created these systemic indicators that basically they say that today the situation is worse than it was during Lehman and during the dot-com crisis. So this is our little contribution. Okay. And actually the systemic indicator was indicating that already a year and a half ago. But then what happened was that the sugar rush of the tax cuts created all sorts of back effects and bought time for the market. But actually, this has been with us already for a year or 2 years. So it's not new, really. This is just the tail end of a topping process in the market, which was probably happening at the end of September, the 21st of September, when the S&P went into all-time highs. That is a top that probably we are not going to see again for a few years. And maybe we will, but it won't last long. And we think it's going to go into transition. What can you do as an investor? I mean, if you're not greedy, if you apply the Warren Buffett's metrics, I would believe that you need to step aside and just get in cash or in something that can be protective of your portfolio. Gold is one, for example, and be patient. Be patient for things to unfold, and then be able to leverage and capitalize on things to unfold as opposed to be damaged by it.
Very good. When people have gold, we always tell them, listen, it's not going to save your portfolio. It'll take the sting out of a correction, 5 or 10% in there, whatever is optimal for that person. But most importantly, it'll actually stop them panicking. They're not going to, the market might be diving. People are panicking. There's blood on the streets. You're not going to sell at the worst time. You might just hold your breath, and wait for the markets to correct, make that mechanism come back in. Those value buyers will come in, and hopefully the market will adjust correctly to where it should be.
I think gold or other ways to ensure your portfolios are a cost, and rightfully so. If they were not a cost, if you wouldn't carry an opportunity cost in holding them, they wouldn't be what you need, by definition, right? So we are living through transformational markets. Central banks have bet the range on the current state of the markets. I believe they're about to lose the range, which is going to be a big thing. They have introduced quantitative easing. They cannot do the same yet again next time around. In itself, it was needed to do that in order to avoid a short circuit. But it was done for way longer than it was needed, up to a point where now it created the systemic risk. So transformational market means we are transitioning into a new set of things. The impact on the market can be very substantial. As you said, we expect the major indices to hit 40% or more down from the all-time highs, which is going to be a proper correction. And the overshooting on that can be much more massive, obviously. In the past. So it's really a time in which to be prudent and to be patient and to be paying what you need to pay in order to secure yourself and do not be greedy. What we say is that be ready, be patient. If you want, as we do, be short, but otherwise you just wait for things.
And I would say to anybody listening, obviously, it's important that you take independent advice. You don't act upon anything you've heard here specifically. This is just kind of opinion between myself and Francesco. But it's important that you look at your portfolio holistically, get good advice. Fee-only advice is usually the best way to go, as opposed to commission, and then build that portfolio, make it fit for purpose for where you are in your life and where you're going. In terms of just very quickly, so we can finish up, how do we fix this market? You said before you kind of agreed that the central bank should have intervened in order to protect the worst outcomes of the global financial crisis. I personally don't think they should have. I think they have opened up a Pandora's box, and now always this is on the table for politicians in the future. Every crisis, there's going to be a political weighting given to it. Will we intervene? Will we intervene? And then I think they're undercutting the physics of the market, basically. But that's okay. We can disagree on that one. How do we fix it going forward? How do we stop these flows from happening? Is there what that new transition? We're transitioning to something else. Do we bring in regulation to stop passive type money or bad actor type money having too much of a say in the market?
There are a lot of things that can be done. I think that still central banks are going to play a role. We wrote a book in August, an e-book together with the Complexity Labs, which is like a shop doing complexity theory. And basically, in it, there are macroprudential policy suggestions. But a lot of it has got to do with the perverse incentives. So the incentives which are built in the system that they create the high probability for you to have bad habits and for bad actors to surface. Right? Is what Nassim Taleb would call a skin in the game, or lack of skin in the game. He also calls it the Bob Rubin trade. What is the Bob Rubin? Bob Rubin was the vice president of Citibank. When Citibank went almost bust, he left away with a big check. He was not taking away the check or anything like that. So it's a kind of like a free riding option that is in the hands of most investment managers these days. If they end up, they should be longer today to make fees and to accumulate AUM. If all of a sudden the market goes down 40%, it goes down for everybody. They're not really going to be blamed for that, or they're not really going to be taking money away, which is in itself is like a problem from a systemic perspective, because it creates no retribution for what you do, and like in terms of how much of risk you put on the shoulders of your company and your investors. It's the same that happened during Lehman, when the banks were putting a lot of leverage. They were levered themselves up 40, 50 times just because like they could keep their money if something was happening. Then there are a lot of other things, like, for example, looking at the market as in a systemic way through complexity theory is definitely one. Utilizing the tools that we already have in other disciplines outside of finance to look at things like that. So try to not have these blind spots, but look outside for help, reach out to other disciplines. That can be done and should be done. Think non-linearly, which is what complexity theory tells you, like be less human that you are typically. So do not think for cause-effect relationship, but look at the system as a whole and try to interpret things in a different manners. Use the right mathematical tools. There are a range of things that you can really do. Like also, for example, the passive investment strategies today, they've got strong tax advantages vis-a-vis active management in several countries globally. And this is an advantage that they don't need to have. I mean, there is no need. There should be a level playing field across. There should be also some recognition of the fact that if everybody is passive, that will create a market that does not look like a market anymore. It's like a queuing system for going longer, as opposed to a buy and selling based on supply and demand. So it's something that does not resemble what we call a market from our knowledge through history books.
Exactly.
There are a lot of things that can be said. We did a long list now.
That's great. It's really good. I think I agree with everything you said. I personally, though, I would be very negative on intervention, official sector intervention. I don't think they have skin in the game. They're political operators, and I don't believe central banks are independent at all. I don't think they've ever been.
You're right. I mean, the big, I don't want to be too severe with central bankers, because I think that there was a point where they had to do something. So I fully see that. At the same time, in the last 3 years, I think we are in overextended territory. It's like a wily coyote that goes through the cliff and doesn't realize. So we are really moving in thin air. And this has been created by the perpetuation of quantitative easing beyond the point where it was really needed. At the same time, I think that there is too much plausible deniability. So there is so much that they can say. So they have no problem in manipulating the market. So to go against the Adam Smith's invisible hand and go and get themselves into buying bonds, mortgages, and also equities, as you said, in Japan and in Switzerland.
It's crazy.
But they have a problem then in saying we cannot know a bubble except in retrospect. So I see a big contradiction there. So you have no problem in intervening in the markets, but then you cannot allow yourself to have a role in detecting the bubble if it shows up, and you let it go until it busts. This is something that I don't understand. I think they should have more of a role also in controlling pricing anomalies in the market, controlling bad actors through behavior, through correlation across investment strategies is not too much to ask, and they should have, through their mandate, also systemic stability, and not just inflation or growth.
But they should be agnostic as to the market direction. They shouldn't care if the market goes up or goes down. A market cycle is a positive thing. When a market goes down, you have creative destruction. You have bad companies being pushed out of business, and you have good companies being emerging from the ashes, and you have better value. I mean, there's a function to this. If you're a capitalist, you take the good with the bad, and what you want is resilience over time. And when these central bankers get involved, they just prop it up. They issue free cash to certain sectors, and they say, keep this political narrative. Everything's okay. Well, no. Let's say let those banks go bust. Let those savers lose their money. They shouldn't have put their savings with those banks. They're too lazy. They're not looking at the details. They're not looking at the rates. They're not looking at the terms and conditions. So caveat emptor. I mean, I'm an absolute believer in this.
You're absolutely right. And also, like, the other point is, like, if anything, the bubble in the market has created more income inequality.
Yeah,
Right?
totally. Look at those those FANG stocks. You have less companies coming into the markets now who are disrupting. You have wider margins, historically greater margins now on these companies. They're making more money because they have more access to these markets which they control. They have barriers to entry now that they never had before. So there's huge inequalities creeping up in all of these markets.
And one of the example that I used, like a couple of years ago, Microsoft could do buybacks in like billions and billions. I think it was like 40 billion or something within the same year in which they boosted the dividend, within the same year in which they laid off 10,000 people. Yeah. So if there is a better explanation for income inequality and quantitative easing, please give it to me, because I don't find it.
I have, just before we go, because it's such a doozer. There was an example there of McDonald's. They did a bond issuance in the States, I don't know, 4 years ago, and they got it away at like 1.8% yield, which is not bad for corporate debt. And the next year they went in, they did the same 400 million, whatever it was, but they issued it in Europe. And the only people who they got away at 1.4% yield, okay? And the only one who turned up to buy the bond was the ECB. McDonald's then took the money back to the States and then basically did a buyback of their own shares. So it was like, you're like, what the hell? It's printed money from the ECB going back to the States and buying back shares. It's not building anything, not doing any value. It just shows the absolute nonsense that can occur when this interventionism goes too far. And,
absolutely. Now, income inequality is creating populism in various shapes and forms.
Totally agree on that one.
Globe on a massive scale. And now we are going to see a regime change from the political side of things. But it's really coming from the markets eventually. It's coming from monetary policy, going through the market, ending up in politics through the electorate and deciding to vote otherwise and for somebody else, which is understandable. And I think that one of the teachings of complexity theory is, for example, that the policymakers are not looking into is the buffers, right? So, for example, over the course of history, bonds could save the day when equities were going down. This was true in 1929, in 1987, in 2000, in 2007, 2008. This won't be true now because rates are too low. So this makes this potential crisis, way different than those ones, and potentially most devastating because a lot of the portfolios are balanced portfolio, which means a bit of equities, a bit of bonds. You expect the bonds to do something good when the equities does really bad. This is also part of the risk parities transactions. Why are they so much involved today? Because they played very well in 2008. Why did they play well? Because the bonds saved the day. This time around, it won't happen.
No.
So it's a very value destruction within financial portfolios, which will then have repercussions for the real economy and will end up creating also unemployment and output loss. And this is what, from a systemic perspective, you have lost a big buffer. The buffer makes you more resilient, less fragile. The bigger buffer out there is bonds, government bonds in particular, and the liquid and the high-grade government bonds. Corporate bonds, you have lost it completely, which is really, really a point of fragility.
Yeah. It's interesting. So I think keep your heads, maybe invest in cash. Cash is not an investment per se normally, and have some gold there. But don't panic. It's going to be transition. There will be opportunities down the road. Hopefully, whatever emerges from the ashes of this market will be more resilient, and the people who participate will be more respectful of proper market dynamics, and we can use it as a means to reinforce our capital markets around the world and reward good companies and put bad companies out of business. Yeah.
And I think that to sell stuff and go into cash, like if you want to really be basic about it, is a good timing to do it. I mean, it may not look like because there's a little correction, but there has not been any correction. If you look at the indices, they are flat year to date. Yeah. Most of them in the US. And they are only 5 or 6 points away from all-time highs. So it's really right at the top. Nothing has happened yet, and everything can unfold from now on. It may take 2 years, it may take 6 months. It does not matter. It's irrelevant the timing with which it unfolds. It's not to be proven right or wrong tomorrow. It's going to take time for it to unfold. But if it does unfold, so there is a serious damage ahead.
Super. Listen, well, I've got to tell you, I found this really interesting conversation. It's absolutely brilliant talking to you. You walk the walk and talk the talk. You're a very successful fund manager in your own right, and manage a significant asset base there. I can't thank you enough for giving us your time today. I hope everyone enjoyed it so far. Later on now, we're going to be, myself and the chapter, Mark and Dave, are going to talk about a little bit more about what you've talked about here. But I think we'll say thank you so much, and wish you very well.
Thank you very much for the invite. I really like this, and it's great to be talking about these topics.
Brilliant. Thanks so much.
You're listening to the Goldnomics Podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed.